welcome everybody here tonight. We thank everybody for coming. So we're going to do a lot of different things. So we're like an open book test. Do you know where to go and where to look? Awesome, this is it. So we're going to be talking about taxes. One of the things that's super important, it's not how much you earn, it's how much you keep that really matters. So it's super important. Tonight, again, we're honored to have Bill join us, and we'll do a little bit of an intro later on that. But so just to start out, we're going to talk a little bit about who Massive Capital is, different partnering opportunities that we have. We're going to talk about the income tax framework and Massive Capital strategy, and we always leave plenty of room for Q&A because that's actually the best part. Feel free to ask questions in the chat. We often don't stop in the middle of a presentation to answer them, but we may, especially if it's exciting and timely. So Bill is the only professional here, and he's not giving professional accounting advice because you're not his client unless you're on this call and you're client. So to make sure these are educational webinars, our goal is to provide you with the best information that we can. But we want to make sure that we are clear that we are not professionals, other than Bill, he is a professional, but we are not here to offer advice or anything. But it's basically a way for you to learn, take this information, and then go speak with your own professionals within your network to verify it. We're not doing any offerings or anything here. So just that's our disclaimer, and we're off on a roll now. So I think we're growing a little bit. So I never see Shirar smile so big than when he puts up this slide. So Massive Capital is merging with Realty One. There'll be more information on that. But as you can see, it's a pretty big deck of people. So at the top, we have a lot of the Massive Capital team. So investor relations, marketing, chief of staff, legal counsel, education director. We've got lots of things, but we're merging. There'll be a lot more information. But as you can see, Massive is becoming massive and true to its name and very exciting. So a little bit about what we do. We do everything just about in terms of real estate. On most asset classes, not all of them at this point. So we do land development, building construction, building operations, and building renovations. So that's a pretty broad spectrum, but we're everything from land entitlement, new development, value add, multifamily. We're adding another few things in there. We all know that we just did the exciting X-Space project, and it's super exciting to be involved in that. So if you look at Realty One partners across the top, they've got a lot of retail centers and retail town centers, which are basically different. They have about $290 million in assets. On multifamily, we have about 336,000 square feet of multifamily. It's just a different way to look at it. We're all used to looking at it indoors, so it throws me off a little bit. Obviously, X-Space, which is happening, about 1 million square foot, and Massive Capital itself has assets under management about 145 million. So combined, we're starting to get a little more massive, I guess is the way to put it.
Thanks, Trevor. And every time you talk about X-Space, buddy, your smile just goes up all the way, right?
I love X-Space. Can you tell?
Yes, I can. And it is true that, from the construction perspective, it's all about rentable square footage. From multifamily perspective, it's all about unit count, right? So I had to go back in, and when I talk, I was like, hey, we have about 1,300 units. It's not that bad, right? So it's working towards it. So when we, Trevor, you want to talk about that slide too? Sorry.
Yeah, so just a little bit, this is just a little bit about Massive Capital and all of our different assets and different things that we have. So if you look at last year, we have about $140 million in assets. So far this year, we've been a little bit busy. So we closed on a land development in Austin, Amberwood Apartments in Dallas, Texas, finally closed on a value add in Georgia. Super excited about that. X-Space is closed. And when we mean closed, we're closed on our capital raise, but really the project is just beginning. So a lot more to come on that. And then we're working on a retail center in Houston, Austin, and we still have our value add in Denver, Colorado. We're 95% subscribed, and we have a little bit of room if you're interested in investing in that one. It is a 506c. So where you see 506b, we're not talking about those particular deals. We're just telling you that they're coming in the pipeline.
Thank you. And there's quite a bit of people in the waiting room. If you can add them in, team, I'd really appreciate it. Right. Okay, next one. So
go ahead.
Trevor, this is a new slide I added. So Massive Capital, first of all, thank you everybody for joining today. It's late of the day. I know you got families and kids and other important things to do. And for some of us who followed Massive Capital since last year, you have seen us growing. And one of the things that we say that relationship, partnership gets built on a skill set, and relationship comes afterwards, right? And so as of now, where we're going towards, we started from owning an asset to becoming a partner, so we own and operate. Now we are getting into the ownership and operation. On top of that, we're adding a development component to it. So moving forward, that's a version of where we're trying to go. On the left-hand side is the Massive Capital. So we have our equity team, investor relations team, that look at LP and institutional. We're bringing in a brokerage company and a property management company in terms of development, construction, and education. So it's a vertically integrated development company that we are taking Massive Capital to. So more to come as you go. And this is a primer to what's coming in the pipeline. So most of the things that we'll talk about, it is based on our own experience, based on the data sets that we have in-house, and then we go and share that with you guys. And again, it's just educational purposes as we go. All right.
Just a quick question. I'm a co-host, so Jasmine somehow lost her host. So if you could make her one. Sorry,
okay,
I'm trying to
no
figure out how, but I'm only a co-host, so I can't promote her.
Give me
even
just
though
a
she
second.
deserves to be promoted.
Well, she's always there. How do I do it? Make her host right there. Boom, Jasmine.
Awesome.
You all set.
Thank you so much.
Awesome. Thanks. So when we put everything together, the question is how do we add value, right? Our philosophy has been from the very beginning is we grow together as a team, and whoever has followed Massive from the beginning, you have seen that we took the conventional thing, but we did it a little bit more unconventional way. Instead of us pushing us, we push as a team. And so we have 3 segments that we add value for the land and new construction perspective. If someone needs help on the land due diligence that is under contract, or you are getting under contract, or you own something, you want to figure out which way to swing it, whether it's a single family, multifamily, town centers, retail centers, strip centers, office, whatever the case might be. If it's Houston, Austin, San Antonio, and Dallas, between the R1 team and us, we have about 40 years of data. And then JV partnership, it's if you have land that you own, and then you're looking to develop, but you have to go figure things out. Yes, you can go figuring out, but the figuring out, it's expensive and costly way to go. But for us, we are fully integrated, so we can help with the development, construction, and lease up. We have quite a bit of projects right now that's going in. There are a couple of projects, we didn't talk about it. We had a 17 acres one under contract in Katy area, and we are a preferred commercial builder for one of the major developers here out of Texas. And that is going to be a Class A right by Grand Parkway and I-10. It's a 17 acres mixed use town center. That's an example. New dev and construction, we can sponsor projects to manage the construction projects with our in-house JCs. We have our own construction company and own JCs that we can manage. In other way, risks are there, but risks are mitigated under one umbrella. And we're in a little bit of better control in terms of how the money flows, speed, and the staging of the construction projects. And if someone has a new construction project, then it credit improvement as a sponsor team, and it's a balance sheet, liquidity, and operational know-how, we come in and help that as well. Existing multifamily side is a similar version of it. In our development construction team, we have 2 wings. One, it's the metal frame. That's where the retail component comes about. And the other one is the wood frame. From the wood frame perspective, for the heavy CapEx, more than $2 million worth of CapEx, if that's needed for a project with a very intense amount of time, we could come in and help. Operations, we co-sponsor with quite a bit of time. We almost all the time we co-sponsor projects by tagging along with the other, by supporting the other GP teams to provide additional oversight as asset manager and also take them through the process. And the last one is the credit improvement. Same thing, our balance sheets, operational know-how, and liquidity we add to the GP team to improve the likelihood of winning a deal. Last one is the education. For us, its education is important, but we think it's in the time you need much more technical than the operational, which is gone in those days where we call 50 brokers and trying to win by competing on a price, right? And it takes a little bit more to it. So we have our own CRM that we build for our own marketing system. As you guys know, we do quite a bit of work. So that CRM we provide to our partners at cost. Then the certifications, oftentimes we get into folks who want to get into multifamily, but they don't have a quite understanding what the multifamily is. If you want to test yourself out, get yourself grounded, that's something we partner with the family office group out of Florida to create a certification program. Again, that's at a cost. We don't do anything which is helping our partners. Last one is the accelerator program. We teach our partners how to create a differentiating factor to win deals. Right? It's a winning a deal. It's an expertise. It takes a different way of looking at it. And us, last 18 months, we have done 15 deals, and it is tough to close 1.5 deal a month. And it takes a different way of looking at it. We had our fair shares of bruises and cuts and battle scars. So what we do, we add that to our partner's resume to make sure that they increase the likelihood of winning a deal. All right. Trevor, this is yours. Come on, take it away from
All
here.
right, so I have to have a shameless plug every time I go now. So I know we have a couple of shameless plugs. So we talked about it a little bit earlier. So this is our second property that we have in the Denver market. It is a 506C offering. We are very, very close to being fully subscribed on this. And so we'd like to give everybody an opportunity. And we actually have a unique offer. So our normal minimum on this is $50,000. But if you're new to investing with Massive Capital, you want to kind of have a little bit of sneak peek into us, we lowered that limit to $25,000. It's a great asset, great projected returns. And it's our second one in the Denver market. Our first one is doing awesome. So reach out to somebody on the Massive Capital team, scan here, but it's my shameless plug.
One thing too, this is one of those partnership models. We partnered with Nirmal last year, bought an asset. We had two partners and both of them are great, but one decided to stay in the multifamily, one decided to break out, right? Experience matters. Once you take a bite of the food, you know how good it is, right? Or you may realize it's not your cup of tea. To Nirmal stayed. Denver is a very crazy market to break into it. We had to do a lot to get ourselves into that critical workflow of the properties. This one came about. Interestingly, we closed this property the same day we closed the first one. So here we are. And we also own a retail space there. So we have 3 properties now in Denver market. And we also have construction license in Denver market. So we are there. It's a nice setup for us in the Denver market.
Awesome.
Trevor?
And you're going to miss out if you miss out on this one. So, there is the most important part of starting your real estate journey, continuing your real estate journey, whatever it is, it's your continuing education. So we have a virtual conference that starts this Friday. It's 8 a.m. Central. So yes, you got to get up early. West Coasters, get to bed early Thursday night so that you can get up with your cup of coffee. But this is very interesting. So it's going to be 2 days long. It is free for you to join, but there is an upgrade. Now you have to promise not to tell anybody my secret code. But if you put in all cap letters, VIP investor, because everybody who comes to our Wednesday night calls is a VIP investor, you'll be able to get that for half off, and it just gives you a few extra options. So I'd like to offer that to you. Don't tell Jasmine I did it. I think she's on mute, so she can't hear me. But this is super excited. We're close to about 500 people registered for this event. We've got like 50 speakers. And it's not just Massive Capital Group, right? We brought a lot of other experts in. So this is something that you don't want to miss. It's our first virtual. And again, it's free if you don't want to get the VIP access. But I think once you get started, you're going to be sorry you didn't. So thanks. It's going to be awesome. I'm super excited.
Hey, on that note, we appreciate everybody who signed up. We always look at it from the education perspective. When all of us, the entirety of the Massive team, we started somewhere, right? But someone gave us the hand, someone gave us the tap on the shoulder, someone stayed with us. So all the things we are sharing up until now, last 20 minutes, it is from that perspective. More you see, more we expose yourself or ourselves into a certain type of work, more we understand. So even though you felt like we talked about Massive Capital, but underneath that, we are giving examples of types of deals, types of assets, types of locations before we get into the core of it. We use the same philosophy. One of the things that we have done in this conference, when we go to the typical conferences, there is a speaking engagement inside the conference room. There's a hangout in the hallway. Some of us would like the hangout. Some of us, we pick and choose the virtual conferences or the speaking engagements. In this case, we coupled them up together. We said, hey, how about just like that speaking engagement sessions, we have a longer time for network. So we want you to come in and network with others and get to know others. And we have taken that philosophy to design this conference. Hey, come and go, no problem. But make sure you attend those conferences, especially the networking events. So please come join us. And this is our first one, so we'll make some mistakes, but bear with us. We'll get better as we go. All right, that's the case study. So Trevor, is it okay if I take it from here?
You go.
Awesome. Thank you. The tag on the right, government is the enemy till you need a friend. I'll let you guys ponder on that one. Left, right, most left, far left, whatever it is. Think about that a little bit. Then we'll come back and talk about that later. Or if you want to have a debate about it, fine. But always remember, government is the enemy till you need a friend. Okay, so what I will do is that I'll share a little bit more context before we get into it, the taxation. Again, full disclaimer, this is for educational purposes only. We have our best friend, Bill. Bill, I'll tap you in a little bit. Whole idea is that before we start the journey, there's an approach to the journey. And next couple of slides, we'll talk about the approach to it. And this is not a detail. We will avoid to get into the detail till the tail end of it, your specific questions. But in general, we want to give you enough of information that triggers your thoughts, makes you go and do something. Whatever the case might be, makes you and do something. And as we speak, from majority of our team has been through almost all of the categories that we're going to share. So if you have some questions, reach out to us or specific questions, Bill is all yours in about 10 minutes out. So I took a screenshot on the left side. It's 2023 tax table. I took the married. I love you guys, the single people, but hey, let's look at the married first, and a part of that is single. It's the taxation, right? Trevor, at the beginning, he said, yes, we earn money, but how much we keep, it's a more important thing, right? So how much we keep, that is as important as how much we make. Second thing is that money that we earn, trading our time, it's the most expensive. Money that our money earns is the least expensive. So that's one on the left-hand side. The folks always look at your P&L, your personal P&L, doing everything the same way. But if you can go down from a 37% to 24% to 12%, that's a gift that you can create by spending 2 hours a week, maybe 1 hour a week. If you're making six figures more, spending 10 hours a whole year. And if you could do things a little bit more nice way, that puts you on a 37 bracket to 22%. That's a big chunk of change you can save, right? Also on the right side, just wanted to share that the bonus depreciation, that 2022 was 100%. It's phasing out. So this is the year we get 80%. And then we'll talk about the depreciation more as you kind of go through. So, and then next year goes down to 60, then 40, and 2027 it pans out. Majority of us, we stacked as much of 100% as we could in 2022. Also, we're stacking up for 2023 as well. That triggers for the high earners really, really quick as you go. So as you look at it, ask yourself, what can I do? If I don't do anything, just spend about a 1 hour phone call with somebody and flow my investment a certain way, that could lower my income tax bracket from here to here. On that note, there are two kinds of income tax incomes. One is a W-2, one is a non-W-2. So we'll kind of talk about that as Bill comes in a little bit down the way. It's that. Second one is, again, this is a playbook. Massive like to say we always have a playbook. We have a strategy. Life is an open book test. And if you know kind of sort of how the book looks like, when the things come, we can go and ask. Go to the chapter, right? So in this particular case, so think about money, post-tax and pre-tax, right? So again, this is a very generic framework. There's a lot of nuance associated with it. And I will share the screen as you go. So you can take a version of it and talk to your CPA, your tax strategist, your tax specialist, and say, hey, how do I fit in? What bucket I'm at and what bucket I need to be, so that I can reduce my taxable income by maximizing my depreciation. So post-tax, outside money, that means by the time money comes to us, I already paid the tax. I cannot do anything about it. So W-2, it's like that. By the time we get our money in our bank account, I already paid tax. Then on the columns are three things that reduce taxable income. That can I reduce my taxable income? Can I defer my taxable income? And then what's my investment hypothesis could be. In a W-2, you really can't reduce it. And what are you going to write off your cell phone and your car bill? That's about it. But you cannot defer it quite a bit as well, because its taxation doesn't help in terms of a depreciation. Your business income, yes, you can reduce the taxable income. Defer taxable income, probably not. Can you get a depreciation? Probably yes. Your investment income, the core focus of it, you can reduce taxable income. You have lots of different write-offs. You can also defer the taxable income, and you get the depreciation. So depending on the investment that we do, going from right to left, if you can stack up depreciation to defer the taxable income, and you can do some write-off to reduce the taxable income, you get best of the both world, and your goes down. And your goal should be over time, your W-2 income is, if that's your primary today, investment income should be primary sometime down the way. So this is where you pay the most amount of bill, because W-2 is the most expensive income. Investment is the least expensive income. So when we talk about passive, that's the flow of money. I'm trading my hour today, and here my money is trading that money's time. I'm not trading it. That's the goal. Second one is the post-tax or pre-tax inside money. When we call it outside and inside, outside money is that I can do whatever I want to do. Inside money is that it is in a bucket. It's within a defined area that you cannot do everything what you feel like to do. IRA, Roth IRA, solo 401k, it's like that. You cannot reduce the taxable income. You cannot defer the taxable income, but you can minimize, you can eliminate tax. So I should add that. So you cannot do not those, but sorry about the typo, but you can eliminate tax quite a bit into those buckets. So your best friend will be your government if you really say, I want to grow my money at exponential growth. Third one is the sheltered money. That means it is not pre-tax, it is not post-tax, it's somewhere in the between. That's what happens when you get to the trust 1031 DST. That means you have earned quite a bit and you have big income. A lot of people will talk about 1031. It's great, but once you hit 300, 400, $500,000, it becomes more viable. DST is great. Once you hit $1 million, it becomes more viable. Trust is a good thing. This is like I posted in from at the beginning, then as you grow, right? But most of our conversation will be today around the IRA and the investment income that you go. And as you grow, we can create the trust and 1031 and DST. Full disclaimer here that, hey, I want to show one more time, this is not and should not be constructed as any offer. This is purely from educational purposes. Hey, Bill, do you want to add something to this before I get to the second slide?
No, sounds good.
Cool.
Question
Thank
about
you.
the DST. It stands for Deferred Sales Trust.
Thank you. It's not the Delaware one. Thank you. So, hey, if you are thinking about DST, you have a different problem, talk to Bill. He'll take you there. If you wanted to trust, you got there, you have a different set of solution that you're looking for. Talk to Bill as well. And so we'll spend a little bit more time on this one, the post-tax money, outside money, and also the pre-tax money inside the bucket money. One of the interesting part is that to bring money from a W-2 to IRA, it costs a little bit more transaction, but once you're in the IRA, it gets really, really fun. So as an investor, what we need to think about is how many ways I can invest and how many tools we need to have in our toolkit, so when a deal comes in, I can go play. With that framework, we're going to run 3 scenarios. The Bill, I want to put you on the spot, right? So we're going to run 3 scenarios. That what if we are a couple where both parties are working as a W-2? Second one, we talk about, hey, working with a couple with one party working, one party stay home and owns a business. So you have one income. Oh, and the third one is, can you go on mute, Michael, if that's okay? Oh, please, thank you.
I want to.
They're trying to find it.
Thanks. And last one is working couple with one party working and second party stay home, right? So Bill, if you take the first scenario where both parties working and W-2, let's say me and my wife 5 years ago, both of us were working, sell an Exxon, how would you say I would go about using this framework and start thinking about investing?
So what you're probably looking at there is taking advantage of cash flow, using your real estate for cash flow, investing into properties, usually taking the depreciation up front. So you're going to kind of fall into the first category, the W-2 income. And what you're going to end up doing is that's going to be called non-qualified money, because like not inside of an IRA, not inside of a 401k. And what you're doing, you're setting up something to give you future cash flow and like what we like to call defer, 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 die. So you'll be getting cash flow, deferring the tax payments. It's not the same thing as tax-free, but deferring the tax. And in the event one of you dies, which I hate to say it, 1 out of every 1 people die, but when that happens, depending on if you're a community property state or a separate property state, you might get all of it wiped away. All those tax deferrals might go away, or half of them might go away. So both people working, you're probably looking at the first scenario, looking at investing. It's not going to save you current tax dollars, but you're going to set yourself up for a nicer future.
So Bill, let me kind of think it through. So let's say we're working and we have $100,000 to invest, right? And it's a 3-year cycle. I can get some depreciation and I cannot take more than 3% now. But when I get out, how that's going to benefit me?
Okay, so what happens is when what we've been doing, usually what happens in the real estate, you front load the losses. And so then you start taking the cash flow on it. Then when it sells, some of that gain will be considered ordinary income and some will be considered long-term capital gain. If you do nothing other than if that's your one and only investment and you cash out and walk away, you're going to pay tax on your gain. It's not getting rid of it. But if you've got multiple investments and you've built up losses from multiple investments, kind of like if you go to the gym, it's a good reason you want to work out on your arms, your legs, your core, your, everything, a little bit of everything. If you've got multiple and diversified, you can use the losses from one investment to offset the gains on the other. Again, or you can use the sale proceeds and buy into another real estate deal. So depending on if this is your one and only investment, depending on if you have more investments, and then depending on when it sells in 3 years, what you want to do, you may or may not have to pay any tax.
Let me make sure I understand. So let's say I have $100,000. We are working in W-2 and I get some depreciation that I cannot realize because I have W-2, right? And we invested it. Let's say 5 years down the way, I get $200,000 back, right? So I have $100,000 of taxable income. Now, correct. If I take the $200,000 and reinvest, am I going to hit that, the deferred taxable income bucket?
Very possible. Okay. So what happens is on the $200,000 you invest, they are going to go into a new investment, and depending on what that new investment is. So if you go into a land deal, probably not. But you go into something with a structure, something that can take advantage of the depreciation. And we're not even talking about a 1031. It's kind of like, sometimes I call it like a lazy 1031, meaning we're going to pick up the gains from the first one, but we're going to offset it with losses from the future. And the nice thing is your gains from the first one, a large portion of those will end up being capital gains. And so they kind of go on a second track. They're not going to be like on that 37% tax bracket. But when you pick up the losses from the new deal, they do save you at 37%. So real simple math, if you're at 37%, or say a 30% bracket, and your long-term gains are 15, what that's saying is you just said you had $100,000 of gains from the first sale. Kind of making it simple. You put in 100, got out 200, long-term gain 100,000. Well, you only need to have a tax loss in your new investment of 50,000 to offset the gains of 100, because your tax losses in the future one will save you 30% tax, where you're only getting hit for 15 on the old one.
Okay, so let me kind of understand, or I reply back, then you tell me if I'm going offline. So let's say my salary is $100,000, right? And I have mid 20% of income tax bracket that where I'm at, right? But if I invest $100,000 and that money makes return of another 100,000, I pay only 15%, right? Which is my long-term gain. And if I choose to reinvest to buy and if I choose to reinvest that $200,000 in a asset class that has depreciation, then on one side, I'm supposed to pay the tax. On the other side, I get a depreciable write-off, then net out. So that's not a taxable event for the year, right? I cannot defer the tax all the way out.
That becomes what you end up doing, is deferring it. So you're using the losses from deal number 2 to offset your gains from deal number 1. Now, what I always recommend is when you get ready to sell or something's about to sell, look at the numbers. I mean, I say talk to your CPA. It could be a tax professional. They don't have to be a CPA. There's some really good enrolled agents out there. There's some really good tax preparers that know their stuff. Make sure the person you're talking to understands real estate. But what you're looking at is, okay, hey, so I'm looking at these losses or these gains, and then, or I'm looking at these much of a gains. How much do I need to invest to not pay the tax? And then in which case, then in your investment, you're talking to the new lead investor. Hey, are you planning on taking bonus depreciation? Are you planning, is it going to close before the end of the year? So just buying into a new deal doesn't help you unless you kind of know what you're getting into. So questions you want to make sure you're asking the lead investor, hey, what are your plans on doing this? You know, hey, when I say loss, it doesn't mean it's losing value. It means you're taking a tax deduction. And the depreciation is nothing more than saying, hey, you could divide this over 27 years, but why wait? Let's just go ahead and take it all this year. And so you front load the deductions. We're not getting extra. We're just legally taking things that instead of waiting 27 years, we're going to go ahead and eat our cake today.
Full disclaimer, we all pay taxes when the time is ready.
Yes.
And when the time, but I just don't want to pay the tax today. When it's right down the way.
And if we die, who cares? We're dead.
Man, you like to kill people, but fine. And I just pay the tax later, but don't have to pay the tax today. That's fine. That's the point.
But your wife said it was okay if you die first.
Statistically, we go first, right? Okay, fine. Okay, now back to the question. Let's say I'm in a W-2, right? And I have, so one of the hot burn when I left Shell, what I realized my pension was making another 3% if I keep the money on the Shell, like a 3%, right? And I had a good chunk of change. Then I said, I'm going to move it to the IRA. So I rolled that over to my Roth IRA. Bill, could you explain a little bit, how does the Roth IRA works if you just earn in terms of a taxation perspective, if you make money within the Roth IRA, how does the taxation work?
Okay, so inside a Roth IRA,
no debt, by the way, pure cash.
Yep, pure cash. So it works on what they call a first in, first out basis. What that means is you put money into your Roth IRA. So when you put it in, there is no deduction to put your money into the Roth IRA. That's after tax money. And so say you put 10,000, $5,000 a year in for 5 years, you've got 25,000 put in there. and say it grows to 35,000. So you're sitting on 25 of principal and 10 of earnings. If you want to take that money back out at any time, doesn't matter your age, doesn't matter your tax bracket, you can take your original principal back out with no tax, no interest, no penalties. Your earnings, if you want to tap into the earnings, in order for those, they can be tax-free if you meet two tests. The account has to have been open for 5 years or longer. So meaning like that very first dollar you put in had to have been from 5 years earlier, and you need to be 59 and a half. There's a few exceptions, but basically be at least 59 and a half. So if you start the account when you're 57, you have to wait until you're 62 to take it out. But if you start anytime earlier than age 54, once you hit 59 and a half, all of your earnings will be tax-free as well.
So let me kind of rephrase in regular terms, right? I have a W-2 and I could start a Roth IRA, or I have some kind of money in the Roth IRA. If I take the money, let's say I'm 40, right? 42. So if I just keep playing with the Roth IRA, cash on cash basis, I don't pay any taxes at all till I'm 62, or when I'm exit from the 62, I don't pay a tax. In other way, it is another version of tax deferral, but don't die, get old, take the money out, right?
That's correct.
At least I don't have to die to get the money. Thank you, Bill.
Yep. And
So
now, and along the way, if you ever want to take your principal back out, that's always tax-free. You can get your principal back out as long you need to make sure you're tracking it along the way.
Got it.
And there is a question too about if you front load it, don't you get bit anyway at the end? So, I mean, eventually you have to pay tax, right? But it keeps, the way I look at it is, if I invest 100,000 and get a $50,000 deduction and save 50,000 in tax, and I reinvest that 50 and keep earning, it's a huge advantage. Correct, Bill?
Correct. I just saw a question pop up about a backdoor Roth IRA. So what the backdoor Roth IRA is referring to, not everybody can contribute money directly into a Roth IRA. It's based on your income bracket. So depending on your income, let's see which, so I'm trying to remember. Okay, so if you're single, it's 153,000. If you're married, it's 228,000. So what that means is, say you're W-2, you're single, and you earn $200,000. You're not allowed to put money straight into a Roth IRA. So what you have to do is put it into a what they call a traditional or a regular IRA. You would put it in, make it a non-deductible contribution, and then convert that non-deductible IRA into a Roth. Now, it sounds like if I take no deduction, that when I convert it, there'd be no tax. Maybe. It depends on if you have other IRAs, because when you make the conversion, it's taxed pro rata. So if you have no other accounts and you open up a brand new traditional IRA and you have no other IRAs, you put $6,000 in, and then the next day you convert it to a Roth, it's now Roth, tax-free, no problem. But say you already had an IRA that was worth $6,000 and you put another $6,000 in, now you got $12,000. And if you roll $6,000 over, 50% of that's going to be taxable because the IRS says you're pulling it from the pool. But this is probably, it's something more detailed. We're kind of getting in the weeds here.
So, Bill, it's one of the things that we use sometimes. It's who, not how. This is one of the time. It's really who, not how. Call the who, forget the how. If I get tax issues, tax questions, Bill is one phone call away, one text away. So please maximize your CPA relationships, maximize your tax accountant and our relationships as you go. Looping back, right, Bill? So if we are a working couple with W-2 and looking at the right side, if I have money outside, which is post-tax, my first preference should be an investment that has depreciation, right? And if I have money inside the Roth, since I don't get the depreciation, my first preference should be investment with non-depreciation, right? Is that one way to get started?
It's a consideration. What I often look at is within the IRA money, what's your total return going to be? So investing in real estate, you don't get the depreciation deduction, but what's going to be your total return, and how do you compare that to the stocks? So Shell's paying you 3%. Well, I would rather take an after-tax, making 3% pre-tax, with no tax, even in a Roth, versus if I can make 20%, heck, I'll pay the tax. I'm going to come out ahead. So depreciation helps, but depreciation gives you zero benefit when it's inside the IRA, Roth IRA, solo 401k. So at that point, it doesn't matter. Bonus doesn't matter.
Yep. And typically what we have seen is that the land investment or the new construction or the new development that has a higher rate of return because less of a cash flow and depreciation not there, they're a very good candidate for the IRA investments. And then if you're looking for cash flow that has typically depreciation but less of a return, that's investment. That's one way to get started, right? At least from the investment side of it, right?
So there is an interesting. Sorry,
great.
go ahead, Bill.
Using IRA money is great. It's just that understand actually even using an IRA in real estate investments, people think IRAs tax defer, wait till I'm 60, wait till I take the money out. You may owe tax when you use your IRA. I understand. I just said you may owe tax in your IRA when you have profits. So again, you're only paying tax if you have a profit. It has to do with carrying a mortgage, more detail than we'll get into today, but just kind of different advantages of sometimes why solo K is better than Roth IRA, just different things that we would talk about in a planning session.
And I just wanted, there's a pretty good question here. I just wanted to make sure we covered. So someone asked, is an LP investor, and when they receive their quarterly distributions from Massive Capital, those are not considered return of principal. And I want to make sure I give the right term. What would they be called?
So there, for IRS purposes,
yeah,
generally speaking, that's a return of your investment, a return of principal.
So these are return on investment. So normally when we make our distributions, correct, Shar, it's return on investment.
That's correct.
On capital. It's only if we do a refi and return some of the capital, then your basis may adjust. But those are return on capital, not of capital. Other than a refinancing or a sale event. Those are taxable at, if again, I'm not far from an accountant, but they are taxable at capital gains, correct? Because they're, or are they ordinary income? Just make sure we answer that first. Correct.
It's what typically happens. You front load your losses again. So making up numbers, you invest $100,000 with your own money, after tax money. You might recognize, say, a $30,000 loss the first year. You build up a bank of losses. If then say you have $1,000 of profit every year, that just means your 30 goes to 29 to 28 to 27. So even if it's a taxable transaction, until you get all your losses back, you're not paying any tax. Now take it, you've got 5 investments, and each one of those investments, say, has a 20,000 loss. Well, until you get $100,000 back, you're not paying any tax.
Money that your money earned is the least expensive, right? Because if you can stack up things right. Now, Bill, building up on that, by the way, I really appreciate this conversation. We have an after party after 7 p.m. and we have about 10 minutes left. So I'm going to touch one more things real quickly. I'll skip that, the number 2, but Bill, on a number 3. Let's say, we are already in investments, and how does my family, me and my wife, I work as a W-2 when she retired from Exxon before me, and then she was staying at home. And both of us are looking at investing, and she is spending quite a bit of time looking at the investment sectors, including the real estate. What is a possible way that we could leverage the time spent by our spouse within the real estate domain and increase the tax benefit?
Yep. So what you end up doing is what a lot of people in that situation go for is they will try to one spouse to qualify as what's called a real estate professional. Remembering also, people hear real estate professional, It's pretty easy to understand that, but they're going to have something else called with active participation. So what that means is the one spouse has to have at least 750 hours a year working in real estate world, a real property trade or business. Could be being a real estate agent. Now you have to own the company. It could be a title attorney. It could be a construction company. It can't be a mortgage broker. Those don't qualify. But something doing your business in real estate world, 750 hours, that's one person. Then between the two spouses, even the one with the W-2, they have to make sure they have 500 hours of active management. Another way of saying things that people that sign the front of a check do, not those that sign the back of a check. So you have to own real estate. Generally, takes about 10 to 15 doors. So you could own single family, you could own an IRA, maybe you GP a deal. You have to be in a position to be able to make management decisions and commit funds to it. Another way of saying an LP, no time you spend as an LP qualifies for the 500 hours. But it's independent of any LP deal, the one spouse qualifies as a real estate professional with active participation. They're able to aggregate and use all of their other losses that they are an LP as, and use those to offset the W-2 income of the working spouse. Only if they independently qualify.
And what if, unfortunately, you had a loss on a passive investment as an LP? Do those passive losses roll over just like your depreciation?
So if you're a true limited partner, you're not a real estate professional, the passive activity losses, they do not go on your tax return. They'll actually show up as a 0 on your tax return, and they will continue to carry forward. Those are called like passive activity loss carry forwards. And if you look at your tax return, they should be saved in the form 8582. And they all group together, all of your passive activities group together. And then if any one passive income category creates income in the future, you free up the losses, and they carry forward as long as you're alive. When you die, they die with you. But also whoever survives, I know we keep talking about death, the survivor though gets what's called a step up, meaning they get to, wipe away all the deferrals anyway. So all that deferring stuff goes away anyway. But so they get to continue to carry forward those losses. Now, passive income, passive losses, basically think real estate stuff that you're invested in that you're not doing something with. That does not include interest income. It does not include stock gains or losses. It does not include mutual fund gains or losses. So it has to be something that's basically another real estate investment, another passive investment. Furthermore, though, if somebody changes and they become a real estate professional in the future, those old passive losses, they don't convert to ordinary. They retain their original character. Once passive, always passive. And so you always kind of want to keep track of what you're doing if you think you're going to be a real estate professional.
So big picture, you have to use all of your passive losses before you die, keep all of your other losses when you die. So there we go.
Oh man. So hold on. I want to make it more fun, right? I don't want to die. I want to appreciate that all the hard work that you all are, that's what we're doing. So let's come on this side. So I'll share a couple of data points, right? For us, again, this is purely data point. From Massive perspective, last year and a half, we have almost 300 investors that supported us, and we raised about $45 million each or so. What we see in general, if I have a W-2, I need to create that the bank that the bill was talking about, the write-off bank. That means you continue investing 2 or 3 times a year, and it builds up your bank. So when there's an exit comes in, you're still a net negative because you have a synthetic loss. So we get to borrow from government at 0% interest rate. Do that all day long. So if you're staying in W-2, keep playing that. Then you add a layer of IRA on top of that. Then you kind of keep on playing it. If you own a business and you have one spouse is not working, if you have big chunk to come in and become an active GP member, then yes, you opened up the door for the unlimited write-offs, right? Every year you realize that one. Those TikTok videos and everything else, you write the Jeep, you buy the car, writes it off, a version of that in real estate. Instead of buying a liability, you buy an asset, right? And you continue playing with it. So depending on who we are, we can play a different way. And as an investor, you want to have options in terms of how you invest and what time the investment matures. If you can play with those two, you'll be in a better spot. So don't look at one, then a two, then a three. I will find out better. Come up with a plan. Look at a 3 years plan. Look at what your earnings powers are. Come up with the investment hypothesis. And what we say all the time, get educated and get started, right?
Yep.
Unless
Now,
you started, you don't know, right?
one thing also, just FYI, kind of looking again at your matrix. So IRA, 401k, you're always probably going to have tax on them, not the Roth. So at some point, when even if you die, somebody inherits it, they pay tax. Somebody's always going to pay tax on the pre-tax 401k and pre-tax IRA. And so I actually prefer, it's great to invest with the IRA money. It's a very good option. But I like, if possible, to invest in real estate with after-tax money. Now, a lot of people are working for businesses. Again, you're talking about the W-2, maybe one person's W-2 and the other one's not. And all their money now, they're thinking, oh my God, what did I do? My money's all trapped inside my 401k. How do I get it out? I'm still working. There's ways to get money out of your 401k, even if you're still working. You don't have to quit and you don't have to turn 60. You can get it out sometimes. And you can also, now there will be tax, but if you do it the right way, you can avoid the 10% penalty too.
Talk to Bill about it. He got me there. That's all I can say. So yes, once you start the framework, it gets really, really interesting. So do analysis on your own P&L, understand what your income is, look at your tax bracket, and then go to your, whoever that you want to go talk. Sometimes it's who, not how. Sometimes it's how, not who, right? In this particular case, it's not how, it's about the who, and you cannot go solve it. Point is, get started, do something about it. All of our massive partners, I would say we all had W-2, we all had business income, we all had investment income, we all have a version of this, not in a ones, like a tens. I don't know, Trevor, how many investment you have done from your Roth or from your IRA? Roughly?
Eight.
Okay. I have done this, my number 17 going on, right? So play with it, and everybody has done it. So we all been through a version of it. And we hope everybody here on the call, you have a version of that as well, but don't sit on it, act on it. I have my brother-in-law forever, he said on IRA money, didn't do anything. Finally, he saw it and he's working on it. And it's impressive how kind of an aha moment you're going to have once you start working on yourself as well. Okay, we're about the time. So I'm sorry, our Q&A time became a discussion time. I'll stop sharing, and hey, we'll take it from here. So Trevor, it's all you, buddy.
Yeah, so there's been a lot of people asking for your contact information, Bill. So
Yep.
Your client base just doubled. But anyways, yeah. So he put his assistant in there.
Yep, Val is going to be the best way. So Valentina Aguirre. For the non-Spanish people, that's Aguirre. So Val is going to be the best way. Send her an email and say, hey, I saw Bill in the Massive Capital webinar. Can I get on his calendar? And then she'll set up, we'll do a video call. We can do like a 20-30 minute video call, kind of talk about your situation. You're here through Massive Capital, so there's no charge for you. And FYI, if you say, hey, I like it, I want to sign up for you, I won't have a contract for you. So when we make our call, there truly is no pressure. It's not like, okay, sign up now, we can do it. There's no fee, there's no contract. If it sounds good to you, and we'll talk about fees, whatever it is on the call, then we would do the stuff for you. But it's not a trick to get you. It's kind of, hey, Massive Capital is a great company. They've been great for me. So just kind of see what I can do to help you. And we can kind of go from there.
You're on mute, Shark.
This is a side note. If you want to know about Massive on the back end, buy Bill at dinner or something. He does all of our books. He knows, There's no hiding from Bill. He knows everything. Right.
So we didn't have a lot of time for Q&A, though we did grab quite a few of them out of the chat. So in theory, we're officially over. But that doesn't mean that this webinar stops. Okay, we call it the after hours, where anything goes. So, our goal here is to continue to provide value. If for some reason we missed your question in the chat, feel free to raise your hand, unmute yourself and ask. And we'll try to continue this and provide as much value. I did mention these videos get sent out to everybody who's registered. I also put the link in the chat to Massive's YouTube channel, and all of our webinars get uploaded along with some other educational material on our website. All of us have been putting contact information in the chat, so always feel free to reach out to us, set up a follow-up meeting. Our goal here is to provide value. I think we did it tonight. No matter what, when I learn a whole bunch, I assume everyone else learned a whole bunch. So I did tonight again. Thanks, Bill. I always say it's the only accountant I know that speaks in terms that I understand. Although I've never heard accounting referred to as going to the gym before. So
Hey, he's the only accountant I know who kills everybody. I was like, don't go that far, Bill. I know it's okay. Let me survive a little bit, So, okay. Now, so this is after hours. It's open book. We'll hang out for another 20-30 minutes. Please ask any questions. Trust us. We have tried to answer some of those really cool questions.
So there is a question on investing with an LLC or an individual. And it really depends on your personal circumstances. So, but
yeah, the bigger thing with that, so what that is LLCs can be anything. They can be a disregarded entity, they can be a partnership, they can be a C corporation, they can be an S corporation. So I often get this from clients when I ask them, they tell me they have an LLC, and I say, well, how is it taxed? They say, as an LLC. And unfortunately, the IRS doesn't recognize an LLC. There's no such thing as an LLC tax. It's either disregarded, which means like a sole proprietor, or a partnership, or an S corporation, or a C corporation, or a trust. And so usually people, when they're LLC and they own it as a person, usually it's a disregarded entity. And in which case, for tax purposes, it's the exact same thing as just investing with your own money.
awesome. Dr. Olu, just go ahead and ask your question. Thanks for joining us.
Thank you for having me here. So this is going to be, I have some non-cash flowing properties, and I've never used depreciation before. Now I've had them for like 2 years. Can I recapture some of the depreciation? That's one. And two, if I recapture some of the depreciation, how soon after I recapture that in my upcoming, when I file for my 2023 taxes, can I sell any of those properties? Okay,
so those are good questions. In tax world, when they talk about recapture depreciation, this is just an FYI. CPAs, that's when you sell. That's kind of like when you peel the layers of an onion and then you put them back on. You're paying tax on the depreciation that you took in the past. It sounds like in your current situation, you have these properties and you have not taken any depreciation yet. Okay.
Yeah, that's correct.
This is going to sound scary. That's bad. Because here's what happens. Here's how the IRS works. The specific words are, they say it's allowed or allowable. That's a short version of saying, I'm going to make up the numbers. You paid $100,000 for the property and you were supposed to take $20,000. And say you sell it and you only get your $100,000 back. A normal person would say, I broke even. There's no gain or no loss. The IRS will say, no, you were supposed to take $20,000 of depreciation. So you were supposed to have a $20,000 gain on that property. Sorry, you didn't take that depreciation, but we're going to tax you on the gain. So what you want to do is, as quickly as possible, catch up with your depreciation. Use the word recapture. And again, that's completely fine. I know what you mean. So you want to, on your next tax return, either want to go back and amend or start depreciating everything you can now to catch up to where you should be, so that when you, and so they're going to give you a deduction. And depending on your income level, depending on your activity level, maybe it's a passive loss. Maybe it generates a loss that you don't get to deduct today. But when you sell the property, you will free up all the losses on that property and you'll pay less tax. If I hear, especially people, this happens a lot, like they use their primary home and then they start renting it out and they get some advice from somebody that says, don't depreciate it. That just means you'll have to pay more tax later. No, the truth is you're still going to have that same tax, but if you don't take depreciation, you're not getting any of the benefit. So you definitely want to make sure your next tax return, you're picking up that depreciation that you're entitled to.
Okay. All right, thank you. And then how soon can I sell any of those properties if I wanted to sell them?
So if you think you're going to sell it and you have not depreciated it, I would amend your prior two returns to capture the depreciation.
Okay.
It probably won't affect your returns any, meaning all it's going to do is create a passive activity loss, that bank of losses, that then once you sell them, you will free up those losses to offset the gains.
Okay.
If you don't do that, you're going to have a tax on the gain with monopoly money, making pretend you took the depreciation. It's going to give you a tax, but you're not going to have any loss to offset it.
Okay.
And you want to keep them normally more than a year, correct, Bill? Because then it's
Long term.
Generally speaking, I like to keep the property for more than 1 year, but don't let the tax tail wag the dog. If you buy a property, it does matter your intent. There's flipping properties are completely different than investment properties. I would say try to keep it for a year and a day to get your long-term gains. But if you get a really good price on it, sell it. Because here's what's going to happen. If you have a gain on it and your intention was investment property, you intended to hold it for long-term, if you can turn around and buy another property in that same year, you might be able to get losses from that new property that will offset a lot of the gains from the one you sold.
Yeah.
awesome. Thank you.
Now, flipping, if in case you want to do flipping, completely different. Flipping is basically like you own a construction company. That's not investment property. That's subject to Social Security and Medicare tax. You've got ordinary profits. And so that's not considered passive. Flipping is something completely different, just FYI.
Okay.
Awesome. Thank you. All right. So Peter from our friends at Freedom Chasers. Should be able to unmute yourself, sir.
Sure, Trevor, I agree with you. I learned a lot tonight, but I probably created way more questions than I can wrap my head around. So I know you talked about if you've got a couple, they both have W-2 income, the depreciation is not going to reduce any of that W-2 income.
Probably not.
That's only a probably. Okay, interesting. I thought that was a definite, but I guess when it comes to the IRS, nothing's definite, right?
It's kind of how much W-2 income do they have? Is it a part-time job? Is it a full-time job? Do they want to become a real estate professional? Can one spouse have two jobs? That's why I say probably.
Okay, I should have been more clear. They both have W-2s. They don't have a business.
Okay, then yes, definitely
Okay.
It's going to get carried forward as a passive activity loss.
Right. What we need to do is get one of them to continue to be a W-2, one to be a 1099 and create a business of some sort. Okay. The other thing, I think what I was understanding is they get into a deal. They put $100,000. They double their money 4 years down the road. Now they've got $100,000 in gain. If they roll that money into a new deal, they could potentially have they have a taxable event at that moment.
Correct.
But if they roll it into a new deal, they can take all of the depreciation up front or whatever depreciation they get from that deal and use it to offset their gains.
100% correct. That's
Okay.
what we call a lazy 1031. Now it has to happen in the same calendar year.
Okay. The problem that I think I see with that is, that's great right now. That was great in the past, but 4 years from now, that depreciation is gone, right? So I'm not going to have that anymore.
What's gone is the bonus depreciation.
Okay.
So, and what the bonus depreciation, now they can change the law too. The law
Of course,
has it as a
understood.
base.
I'm talking based on the current laws, right?
So what they can do though is, yes, so it means the bonus is where they're getting things. So take a step back. Cost segregation is kind of breaking things down into components. So it's not just one monolithic building. You've got a roof, you've got carpet, you've got air conditioning. It's kind of like I say, like you can say I have a hamburger or I have 2 all beef patties, special sauce, pickles, cheese, lettuce on a sesame seed bun. It breaks it down into components.
Right.
When it breaks it down, they still get accelerated depreciation. They might be able to deduct it in 3 years, 5 years, 7 years. They get it. It's not 27, but what it's saying is anything that's below 20, you could do 100 up front, or right now this year it's 80 up front. And so you're correct. It does mean that it's possible there will be less of a big loss up front.
Okay, all right. But there's still some to reduce some of that income. And obviously the more deals you can get involved in, the more losses.
Correct, yeah. They'll still
up.
have things like called Section 179 depreciation, but the Section 179 can't generate a loss. It can only bring your income down to 0. So if somebody's looking for losses to offset something, that wouldn't help. But if they were looking to
bringing your income down to 0 is not a bad thing.
yeah. And so
on that note, though, go ahead. Sorry.
And
Yeah,
so
no.
it's when you get into the deals, that's one of those, as you're about to sell, you want to make sure and do the planning. Now, with that though, here's a thought. That's assuming you're in one deal now, and then in 4 years later, you're getting into one deal. What I'd recommend, get into 3 or 4 deals right now if you can,
Right.
because when you sell that one with a loss,
Yeah.
you get to use the other company's losses as well in that same year. You don't
Right.
have to sell and buy a new one. It's a pool of losses.
Right. Interesting. So yeah, you might be better off if you got 100,000, but you have people that are willing to take 50 or even 25, maybe get into 4 deals at 25 rather than 100 all into one. That's great. That's a great point.
Yeah.
Um,
And also depreciation going away, right? Or it's phasing
Right.
out, assuming rules, it's not changing, then stack up as you go, prep for that. So have a little bit more longer horizon as you do the investments. So again, as you mentioned, some of us, we stacked up as much as we could last year because we had 100%. We created a pool. This year, 80%, next year, 60%. So as it phases out, stack up as much as you can. That's also because, 4 years down the way, I don't have any other way to go. But guess what? I borrowed money from the government for 0% interest rate from now till then. And by the time I get there, I have a big bucket, right? I can play against it. So prep for it.
Yeah, no, that makes sense. One other question about the taxation that you, on one slide, it said it's possible to reduce the business income. What under, and maybe this is too complex, but under what makes it possible? Like what's the scenario that allows me to reduce my business income compared to a scenario that doesn't allow me to reduce my business income?
Okay, so sometimes, so like if you've got your own business, you might create your own 401k plan, a solo 401k plan. And in which case you can defer, depending on your age, the first $20,000 to $26,000 of income plus 25% of your profits, you can put into a 401k. You can use that solo 401k to invest in the real estate, but it's kind of like using your business income. Also, what people do sometimes is they may hire their kids, or they kind of, get the business of, okay, what else can I expense off? But if you're looking to get into the real estate and you own your own business, then maybe you create your own 401k plan. Or if your business is real estate related, and so now you're becoming a real estate professional with active participation, those are now going to enable you to, if you independently qualify the 750 hours of real estate plus 500 of active participation, then you invest in somebody else's syndication, you can deduct the losses from those syndication as an LP. You don't have to spend a penny, a second of time on it because you independently qualified. It's kind of like it's pass fail. If you pass as a real estate professional with 750 hours, the person that has 2,000 hours is not more professional. It's pass fail.
Okay. So just to clarify that, if I have a landscaping company I'm not going to be able to reduce my landscaping income. My tax benefits are going to be through some sort of 401k plan strategy.
Maybe. So here's where people
Always
when
maybe.
people, they hear 750, then they hear 500, and they're like, I don't get what's the difference. So if you have a landscaping company, you're spending 2,000 hours a year on it. So you're going to reach, that's a real property trader business. You just hit the 750 hours, but none of those hours are managing real estate properties. Now, if you're married, you and your wife together, and so if you do everything together, that's 250 hours. Together, you have to spend 500 hours managing your rental properties. That's why 500 and 750 are different. The 750 is real estate world. 500 is specific to rental real estate. So if between the two of you, you and your wife, say you've got 10 single family properties and you spend 500 hours on those, now you are the real estate professional with active participation. And by owning your own business, so it's not if you work for a landscape company, you have to own the landscaping company. You can invest passively in somebody else's deal, use the losses from somebody else's deal to offset your landscaping company income.
Okay.
They're no
All right.
longer passive losses. You freed them up.
All right. I know I'm sorry to monopolize the questions, but that's great information. That's not the question I was trying to get answered. What I'm trying to get answered is if I own a business, but it is not real estate related. I am not a real estate professional. I have no chance to become a real estate professional. Is there a way that I reduce that income with the depreciation, or is the only way to have tax benefits is through a 401k plan strategy?
You're really, probably your only choice is using your business to create a 401k.
Okay.
Because other than that, owning a business is another form of owning a job, which is another form of having a W-2.
Okay.
Investing passively will not offset, like you own a engineering company.
Yeah.
You cannot offset your engineering company income with the passive investments.
Okay.
Bill, what if the engineering company or what if this landscaping business buys a building for themselves and they use that to house it? Then the business owns the building. If I get a depreciation, would that go against the business?
Now, yes.
Sorry, Peter, I'm kind of building on top of yours.
Yep. So now that's no longer an investment. And so in that case, if the company itself owns the building, not you and a couple of partners own a building here, and then you own your engineering company over here and you lease to each other. But if it's an asset of the company, you can, now this is just real estate in general, you can take advantage of a lot of the bonus depreciation because that's a company asset. The same thing as if you bought a copier, the same thing if you bought a computer.
That's right.
Because now it's not rental real estate, that's a business asset.
That's 100%. So thank you. Now this is, again, it's not who, not how, right? Or how, not who. In this case, it's the who is matters, right? Who knows what it is. And each of us will be unique in their own sense. So thank you. No, this was a good one. Now, Jeff, I know you raised your hand and you put it down. And before
Thanks
we go
a lot,
out,
Bill. Appreciate it.
Good. Thanks, Peter.
Sure.
Jeff, you good?
Yeah, I'm good. I had a question
Okay.
about that was already pretty much answered, but
Awesome.
the main thing is if you have a company and you want to do real estate and you have either your own 401k from a previous job, you can always roll that over and into a company qualified plan and turn it into like either the solo 401k or the QRP, and then you can utilize that for your real estate investing. And anything that you pull out for an investment and everything you put back in, if you're under that 59.5, if it's a tax pre-tax or an after-tax, it stays that way all throughout your investment. So it's just an easier way to do things if you have your own business.
Awesome.
Yes.
Yeah.
When you own your own business, it's good. If not, I like the EQRP over just a self-directed IRA because of something that's called UBIT, unrelated business income tax. The EQRP in that situation works just like a 401k when you own your own business because both of them are exempt from the UBIT.
Right.
Awesome. All right, good. Delana, you've been patient. Thank you. Thank you.
Thanks. Great pronunciation of my name. You got it.
Man, I was nervous. I was nervous.
I'm still really new at all this. so bear with me, Bill. Thank you. Your information's been fabulous. On
Okay.
this, on the solo 401k, are we able to benefit from depreciation when we passively invest, or does it only work for GP type things? Because I'm looking for my first deal, but I also want to invest passively, and I'm just not sure what are the tax benefits for passively investing, and how do we, does that make
Okay.
sense?
Almost.
Okay,
You first started with solo 401k.
yeah, I
So-
probably messed you up there. My
so
hubby owns a business,
Okay,
not
perfect,
related to real estate, and so we're
Perfect.
wanting to put stuff through there.
Okay.
But it's new, so we probably need 2 years on that, but then I'm also needing to learn about passively investing and what can we take
Okay.
advantage of.
So we'll start with the solo 401k first.
Okay.
So you can create like a self-directed 401k, and then you can use that cash to invest. The benefit of that is all of the now, I might consider also within the solo 401k converting some of those dollars to Roth 401k. It means you'll
Okay.
pay tax now, but remember, you're always going to pay tax on the 401k money. But if you convert it now before you invest in the real estate, when the real estate doubles, I mean, I'm not guaranteeing your returns. I'm just saying
Sure,
it's all tax free. So you're planning now, pay your tax now for a bigger pot of gold at the end of the rainbow. But you
okay,
do have to come up with the money now to pay the tax, whatever you convert. That's, the downside. But remember, you're always going to pay tax. If you've got other IRA money or other 401k money, you can roll those into your solo K, but you cannot roll a Roth IRA up to the solo K. That's the only one you can't roll in.
okay,
Now, that being said, the investment inside, the investment with the 401k, forget all depreciation, forget all income. It's just like when you invest in stocks or bonds, you don't consider interest, dividends, or mutual funds have capital gains. Municipal bonds pay tax-free income. It's now just dollars. Okay, how many dollars went into the investment? How many dollars came out? Because you're under the 401k umbrella. So there's no different tax rates. There's no long-term capital gain. It's eventually when the money comes out, it's basically a question of, was it pre-tax money or was it Roth money? If it was pre-tax money, it comes out at ordinary income. If it was Roth, it comes out tax-free.
Right.
That's the 401k side. Now,
Okay.
you own business, make sure you're greasing the skids. What I mean by that, when you own when you have 401k, don't just use it to invest and only keep it stale. You want to put new money into your 401k periodically as an active participant. If you don't, and say you go 3 years without it, the IRS is going to question it and say, this is not a valid 401k plan. This is a glorified IRA. We're going to disallow all your deductions, and they're going to throw it to an IRA, which means you may end up having to pay unrelated business income tax. Now,
okay.
I'm not saying you got to max out $20,000 a year. Okay, try. We're going back to the dead man. $1 a year is $1 more than a dead man. So
Right.
something, just as long as you're doing something into it, because nothing. It's really hard to argue that you're active when you've put nothing in it.
Right.
Anything you put in is more than zero.
Okay,
So outside of the 401k, now you invest with what we call like non-qualified money or after-tax money. The benefits to a passive investor are it's really going to be a matter of cash flow. And what I mean by that is you're going to put money in and then you start getting paid cash flow. Well, the money you put in first generally generates a large bank of losses. And as you start getting your cash flow back, until you recover all of your losses, you're not paying any tax. You're just kind of, for tax purposes, you're getting your investment back. It's slightly different, but even if the company makes a profit, for IRS purposes, they're kind of saying, hey, until you recover all your losses, we're just going to say you're getting your own money back, even if it's income, because you're kind of like bringing down the losses until your income exceeds your loss. Typically, that takes about 4 to 5 years, and at that point, it sells, typically. Then you sell, you've got a large gain. If you reinvest that into a new property, or if you've got other properties, that new property generates a new loss. And if it happens in the same calendar year, that new loss can, like, you sell for a gain in January and you buy for a loss in December, they offset each other. But if you sell for a gain in December and buy a loss in January, those are separate years. You're paying tax.
Got it.
Unless you've got multiple investments. That's where I use like the workout example. Your arms, your cardio, your legs, your core. Because if you've got 5 or 6 different investments and they're all generating losses, when one sells for a profit, you first have to recover your losses from all your investments before you pay any tax.
Mm.
Awesome,
Okay.
thank you.
So now this is passively as well. Is that what we're
Actually, everything I just mentioned was passive.
awesome? Okay.
You become an active, like a GP, you become a real estate professional, then you're not building up the bank of losses. You invest in something and it loses $20,000. You're taking a loss on your tax return right now for $20,000 loss. Now, using it now means it's not in the bank for the future, but it's a time value of money. But you do have to prove active participation. Just calling yourself a GP on one deal, you can't just call yourself it. You actually have to prove that you're doing work in it. Like, I'm GP in some deals, but I'm a passive GP. I don't claim to be the real estate professional. But I invest in real estate for the cash flow, because that's why I invest passively. And I've got like solo 401k invested, after tax money invested, GP deals. So I do all of them, but I do it for the cash flow purposes.
So Delane, I'm going to share a link with you, but I'm going to make a trade. So you have to buy a VIP ticket only because this event is on Saturday in Dallas, and it's put on by a company called Quest Trust. And they're going to charge you $49 to sit all day and listen to using retirement funds to invest in syndication. And I'll actually be there so we could meet in person. But you gotta, I hate to put something out there that has you miss Saturday. But because you're Dallas based, it could be well worth attending it.
Yeah,
and
Quest
they do have other events as well.
Yeah, Quest does a very good job. They were probably the leader in using IRA investments. And so they do a good job of, as a custodian of IRA investments, they totally understand self-directed IRAs, and they have solo 401k, self-directed 401ks. Tax-wise, they're treated differently. There's pros and cons to both, but Quest is a good company.
But I put the link in there if you're interested. This Saturday in Dallas. So
Thank you.
yeah, but it's a full day of just about investing in syndications with retirement funds. Be my first time attending, and I'm sure I'll learn a ton. So again, it's not how much money you make, it's how much money you keep that matters.
Yeah, Bill,
This is
sorry, not Bill. Bill, thank you, by the way. And
Yeah,
I
it's been
really
awesome.
appreciate the time. It's been amazing. As you guys can tell, there's so much to talk about it. And so I want to add something to it. As a buffer, if you're actively investing or thinking about it, we have some awesome team members on the investor relations all day long. This is what we do. Reach out to one of them, not for expert advice, rather running back and forth, then talk to Bill and get the expert stamp on it before you make a choice. We can, if you want to run some of your thoughts by, get some understanding of what it is, please reach out to Trevor, Jasmine, Maria, and any one of us in the team. We can give you a directional view. Then, hey, folks like Bill, you get a confirmation from there as you kind of go. So, Trevor, it's about 7:30 in the hours.
Yeah,
Bill,
they're awesome. And so again, remember, we do this every Wednesday night. I don't know what our topic is next Wednesday though. So
it's something about the income taxes coming. I apologize. It's just been, I'm trying to close some deals, but fine.
yeah.
So sign up for next webinar. We'll have another third one on the income tax, and I will try to find a little bit more interesting. Then on top of this one, we'll find out some of the plays that, at least in my mind, we do a monthly, I would say, thematic approach. Last one was the government, whether really they're helping us or hurting us. This one was the income tax. Next week, we'll do another income tax by specific examples, just like the case study. We'll come up with 2 or 3 different scenarios where, Bill, we don't have to die, but we can still maximize the time and the money playing with the government as you.
Yeah, and again, we really appreciate our referrals, right? So my friend Michelle, she invited Phyllis tonight. I know that because we spoke earlier today, and so it's just this is what we want to do, right? We want to build this community. We want to offer value, because at the end of the day, you want to make educated investment decisions, right? You work really hard to earn that $50,000 after tax money, and you want to do the best you can for it. So again, this is Bill, it's man, we could have you like every week, and I think we'd never answer all the questions. But it's really important, and we appreciate everything you do for us.
Oh, yeah, my pleasure.
Thank you. Thank you.
So
Thank you,
yeah, I
everybody.
had a question for you, but I will email you.
No, go ahead. Go ahead, Tracy. Only for you. Go for it.
I just put in the Q&A section, Modi downgrade the bank's rating recently, especially those with the CRE exposure. What are your prospects with regards to that statement? And then the possible implication on multifamily lending.
US is the #1 economy. We have dollars still powerful. Yes, we struggle with the power across the whole globe, but still we're #1. And this is the market adjustment. I would have a zero care for the whole downgrade. But what it means to me is that there is a credit tightening happening. Tightening is going to be there. So if someone wants to buy assets, tighten up your balance sheets, clean it up, get some liquidity, because market's going to get tighter and tighter for a little bit. That's what it tells me. When we downgrade to credit rating. But in general, impact on overall, I mean, there is no impact. It is what it is. Price took a hit, cash is coming in, lending is high, move on, right? So if I look at CRE impact perspective, it's not. And typically credit rating, it's a part lagging, part forward looking. The reason someone gets a bad score because you take a test and test didn't come out right, that is a lagging indicator of how much we studied before. So we saw that coming, which is very typical, very standard, but overall, there shouldn't be an impact at the project that we do because market already adjusted, most of the market already adjusted. Now that's the backward looking. Forward looking, it's again, if you're an LP, if you get a 6, 7, 8% return, then you should invest because cost of borrowing is 8, 9%. That means if you don't do anything, you get 9% return. But that means your return expectation has to be a little bit more higher than what it is. That also means that in today's market, finding those deals are tough. So you have to be really underwriting the deal team and the back end office and how they're sourcing deals, and then trying to see are they getting the deals from the market or they really have a differentiating factor that gives them a leg up of winning a deal, right? So from the LP, you have to do a little bit more homework on the GP teams. For the GP teams like us, it's the balance sheets, it's the know-how, it's going to matter for us the most. We just cannot compete on the price anymore. That boat has sailed, shipped, burned out, whatever you want to call it. It is the technical skill that we have. Whole idea is that whoever is doing the deal today, they must have something more compared to their competition who went after that property. Those are the different ways that we'll take a look at it. Good question, Tracy.
Yeah, so this is awesome. So thank you, everybody. I know I'm going to see each and every one of you at 8 a.m. on Friday morning at our conference. We're very excited about that. So
that is too early.
Hey, it's BYOC. Bring your own coffee. Sit down in your pajamas and turn on the phone.
You don't have to be in your pajamas and not turn your camera on.
We don't. Hey, we are going to join the pajamas and a bottom-down shirt. So come on now, feel free.
Awesome.
Thanks,
all right.
everyone.
Thank you.
Thank you, everybody. Have a great night. Nice to see you all. Thanks again, Bill.
Thanks.
Take care.
Thanks, Bill.
All right, bye-bye.
Thanks.